Good day. In this lecture, we'll cover trading strategies. So the outline for today's lecture will include crossovers, trading strategies, trading journal, common mistakes made by traders, and we will also look at managing your emotions. So the first strategy we want to consider is a price crossover. Price crossover. You may be asking, what is a price crossover? Well, a price crossover is when the price crosses above or below a moving average to signal a potential change in the trend. Remember, we did in a previous lecture about technical analysis, and we used the indicator, the moving average. Well, if it is the price crosses over the moving average, this can result in a strategy called a price crossover. Let me show you. So this is my chart here. This chart shows the price. The asset I am looking at is the AUD JPY, the Australian dollar Japanese yen. So this we have here is the moving average. So if we go into settings, we can see it is a 50-point moving average. How do we find a crossover? Well, this is the crossover here. The asset moves, the price of the asset moves, and then a crossover occurs right here. It crosses from below. It crosses from below. This is a price crossover. Another crossover occurs right here. It goes from above and it goes below. This is a price crossover. One occurred here, one occurred there. So let's change the parameters of the moving average. Let's say we change the moving average along a moving average. So we use a 100-point moving average. Remember when we change the length of the moving average, we make the curve smoother. It smooths out the noise and smooths out the fluctuation more. Well, this happened right here. So as the moving average, we increased the length of the moving average, it became smoother. And yes, less price crossovers occurring than before. So one definite price crossover occurred right here. The price crosses from below. It went up, it went back down. Another price crossover occurred here, but these were four signals. A crossover occurred here, a crossover occurred here, and a crossover occurred here. This was a better signal in terms of the price went from high and went below, it crosses the moving average and went below. Now, you might be asking, what is the relevance of a price crossover? How can this thing be useful for you? A price crossover shows the change in the trend. So recall the moving average. We use a 100-point moving average. This shows us the trend. This shows us the overall direction the asset moves over a period of time. But how can we determine a change in the trend? How can we determine the right point to buy or to sell an asset? Well, we can see here was an excellent point. This point right here was an excellent point to actually buy the asset. Why? Because there was a price crossover. The price of the asset went from below to above the 100-point moving average. This suggests that over the period of time, the asset was going bearish. The asset was going down. However, there was a change in the trend. The change in the trend was evidenced by the price crossing over the moving average, suggesting it going from a downtrend to an uptrend. And we were actually right. If it is we took a buy right at this point here, we could have ride the market all the way back up. So if we buy roughly about here, we can even buy about here. We can ride it all the way up. So we could have sell at this point here, or we could have sell, even if we didn't sell at this point here, it went down slightly, it went back up, we can still sell at this point here, or we can wait, it will fluctuate, and we can sell anywhere around here. But the whole point, if you buy at this point here at $83.56 and ride it all the way up to, let's say, $84, you ride it all the way up to, let's say, $84.30, 31 cents, it would have still been profitable. So this was a good trade. This was a winning trade. Another crossover occurred right here. So the price went from above It went from high and went to below the moving average. This was a price crossover occurring right here. So if we take a short position, meaning that we take a sell, if we sold the asset about here, $83.99, I mean, we could have write the change in the price, we could write the decline in the asset price all the way down. So you could write all down here to about $83. That would have been a very easy win. Now, price crossovers occurred at different points. So let's look at right here. There's a price crossover occurring right here. The asset went from high, it went below, it went below the price here, and then went back up. So basically what this gave us was a false signal, meaning that this suggested a change in the trend. However, there was no change in the trend. For a period of time, the asset went sideways. I mean, when we take price crossover strategies, or when we implement a strategy based on a price crossover, it is a possibility that we can make a loss. However, this loss will not be very large. Assume we took an order about right here, so to sell the asset, and we put a stop loss. We put a stop loss right above the moving average. We can see here the asset actually went into profit slightly. If we leave the order open, it would have turned back against us and would have won a loss. So we could have either two things. Is either one, we could have either break even, or two, we could have taken a loss. If we had taken a loss, this loss would be a very small loss. Again, we could have entered a trade right here. We could have entered a trade to go short on the market right here. If we are taking a trade to go short, when the asset price goes into profit, we could have moved the asset stop loss on the order from a loss position to a break-even position. That's what I would have done. However, assuming that we didn't do that, assuming that we was waiting for the asset to move to our target profit, what would have happened is that the asset would have turned against us and we would have made a loss, but it would have been a very small loss. Now, assuming that we take a sell right here, somewhere about here, so the asset price would have gone down by a large amount. So we would have made a very good or a sizable profit. Let me show you how the profits will look. So if I took a trade here, if you took a trade here, we'd have tried to make a profit about this amount here, and it wouldn't have gone into profit. If we are insisting that the asset going to target profit, we are targeting a profit about this amount here, the asset would not have gone to profit. It would have turned around and won a loss. Let's say we do the same thing. Let's say we enter a trade about here with the same objective of making a profit. The asset would not have gone into profit. The asset would have turned around and hit the stop loss. So I'm just making this smaller. Let's say we take a third trade. Let's say we take a third trade. We set the stop loss about here, just above the moving average. We set the stop loss just above the moving average. And we set the target profit about here. So yeah, we set the target profit about here. We can see this trade ends up going into a win. Now, what I would have done is that when I would have almost hit my target profit, I would have moved my stop loss down. So I would have moved my stop loss to about here to break even point, and I will move the target profit up and let it grow. But assuming that we didn't do that, assuming that we stick to the original plan, our stop loss would have stayed here and our target profit would have been here, and this trade would have turned around and would have gone in a profit. It would have been a very good profit, and we'd have take a win. So this strategy is called a price crossover. So I could also show you when there's a price crossover to go long. So here a price crossover occurs. We could have gone long on this trade. So you can enter order to go long about here. We have steady stop loss just below the moving average and leave the target profit open and leave the trade open. And we can see here, this was a very good trade. This was a winning trade. Why? Because when the price crossover occurs, the asset didn't go back below the moving average. So the price of the asset stayed above the moving average and it just went up. Now, if we set target profit here, it would have hit the target profit, but if it is, we had adjusted the target profit and keep increasing it as time progresses, we'd even make bigger wins because the possibility we can take this win, we can take this win, we can even take wins up to here. So this was a very good trade. This was a winning trade. You can use a price crossover to implement trades, and this will tell us or give us an idea about the direction of the market. So while a price crossover is good, as it can give us a direction about the general trend, and it can allow us to take easy wins, the price crossover is still, well, it is not perfect in the sense that there can be false signals. Recall in a previous diagram, I was showing sometimes you can areas where you can take trades and the trades end up being a loss because it gave false signals. Let me show you. So recall here, there were areas where you could have taken trades and the trades would have been losses. So if you had entered a trade here, this would have been a loss because it didn't go into the target profit. If you had entered a trade here, this point here, that trade would have been a loss because it didn't hit the target profit. It would have turned back and hit the stop loss. So the price crossover is not perfect. One of the reasons why the price crossover is not perfect is because it gives false signals. In other words, there are short-term fluctuations and they are not filtered out. This can be addressed with a crossover called a moving average crossover. So a moving average crossover is when we use two moving averages to determine the crossover. We can use a short moving average and we can use a long moving average. So let me show you. So this is the previous screen we were on here. So let us look at the moving average crossover. You can see here a moving average crossover occurred at this point here. This would have told us to buy. So we could have set this would have told us to buy. We would have set the stop loss around here, just below the moving average. And this would be target profit. We could have write it all the way up. Now, what I would have done when this go on a profit, I would have moved the stop loss from the loss position to break even and allow it to grow. And as the profit grows, I would have increased the target profit. We can see with basic parameters, this would have been a winning trade. So this moving average crossover occurred at this point here. So we would have took a sell somewhere around here. So we have took a sell somewhere around here. I'm gonna bring the stop loss a little lower down. I'll leave stop loss around here. So I would have taken a trade right around here. So the moving average crossover would occur right here. Now we see in this example here, the moving average crossover occurred at the same point with the price crossover. So at this point here, a price crossover occurred, a moving crossover occurred. How we know a price crossover occurred? The asset, which is the candlesticks show the price of the asset went from on top to below the moving average. It went from on top to below the 8-point moving average. Not only that, it went from on top to below the 100-point moving average. So the red line is the 100-point moving average. The blue line is the shorter or the 9-point moving average. So we see a price crossover occurred where the price went from above to below the moving averages. This occurred for the 9-point moving average as well as the 100-point moving average. Not only that, a moving average crossover occurred in the sense that the moving average went from on top to below. So this was a very good sell signal. We see here a moving average crossover occurred. This would have told us to go long. This would have told us to buy. So let's say the moving average crossover occurred here. We will enter the trade somewhere around here. Stop loss would have been here and leave the trade open. This was a very easy and a very good win. Let's just run into profit. This type of moving average that occurred is a golden cross. Where the price of the asset goes from below to above, this is a golden cross. So the shorter term moving average was the blue moving average. We see here the blue moving average. The blue moving average was the 9-point moving average. The longer term moving average is the 100-point moving average. See the red one, the 100-point moving average. So a moving average crossover occurred at this point here. We might have entered the trade about here. We would have set the stop loss just below the moving average, the longer moving average. So the longer moving average would have been about here, this point here. So we have set the stop loss just below the longer moving average. We would have entered order to buy. We would have gone long and leave the trade and let's ride it all the way up. So if we had set a target profit, we would have taken about here in target profit. Or if we keep monitoring the trade and as we see the profit is growing, we could have gradually increased the profit and take bigger wins. In fact, what are the size of the wins? We could have ride this trade all the way up here before this all the way to this point here. Take a very big win. I mean, yes, it's possible we could have ride all the way up to here, but usually when I see a pullback, I might have closed somewhere about here. So we can ride the trade all the way up. So this was a very good trade. This was an easy win. We see here moving average crossover occurred at this point here. This would have been a win, but this would have been a very small win. This would have almost break even. A moving average crossover occurred about here at this point here. So we might have entered a trade here to buy. This would have been a win. Even if we enter the trade about this point here, and you set the stop loss about this point here, just below the longer moving average, this trade would have still been a win. So that is one of the reasons why I like crossovers. I like price crossovers. I like moving average crossovers. As a general rule, the moving average crossover sends less price signals or less false signals than the price crossover because it reacts slower, it filters out fluctuations, and it reacts slower to changes in price. Nevertheless, sometimes, and a lot of the times, when there's a good trade, a price crossover may occur at the same point in time as a moving average crossover. We saw that right here. So sometimes both the price crossover and the moving average crossover tells us the same thing, and we can enter a trade and take an easy win. So we can see these trades, winning trades. This was a moving average crossover. This was a winning trade. 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 This also was a winning trade. If you was trading based on a price crossover would have got all here. And we see it here because the price went above, the price of the asset here went above the 100-point moving average. So this would have give us a signal to buy. However, a moving average crossover didn't occur at this point here. So that is one of the reasons why I prefer a moving average crossover to a price crossover, because a price crossover can still send you a lot of false signals. However, a moving average crossover filters out the false signals. You get less false signals with a moving average crossover than with a price crossover. Even in a worst case scenario, even if we implement the trade at the close of the price of the asset, so assume we will later react to the market and open the trade at the closing price of the asset, we would want basically a 1-to-1 ratio or something close to that, because the stop loss quite off here. If this is such a wide stop loss, we have to get at least the same amount of reward in terms of our risk to reward ratio. So in other words, if it is we lose this amount here, we must get the same amount or more in the win then. And if we set such a wide target profit, this trade would have still been a profitable trade. So this was a very good trade here, and the moving average crossover gave us a very good signal. A moving average crossover with the shorter term moving average crosses from above to below the longer term moving average. This is a sell signal, and it is called a dead cross. We saw it in the previous slides. We saw it in the previous diagrams. This is a dead cross. This is a dead cross. This point here, right here, the moving average crossover occurred. The moving average crossover occurred at this point right here. This is a dead cross. This is a golden cross. This is an opportunity to buy. This was a very good opportunity to sell. Observe, if we took a short order at this point here, watch how big or how large the profit would have been. So if we had sold at this point here, $84.59, the price of the asset would have gone all the way down to $82.61. So this would have been a very big win, easy trade, easy win. And this would have occurred over the period, the 19th of March to the 24th of March. So in a few days, this trade would have been a very good trade. This trade would have been a very good win. So now that we establish crossovers, price crossovers, and moving average crossovers, the next thing I want to emphasize is a trading plan. What is a trading plan? A trading plan is the rules. It is the plan, the system. It is the thing that will tell you how to enter trades, when to take buys, when to take sells, where to set a target profit, where to set a stop loss, how to manage your risk. So as a general rule, when trading assets, you should use about 3 criteria to determine to enter a trade. So our trading system should describe when you should enter or exit trades. So we saw previously with a moving average crossover, one of the first signals from a moving average crossover is that at the point in time where the moving average crossover occurs, it can tell you to buy or to sell. So if, let's say, there was a golden cross, the shorter or the faster moving average crosses from below to above the longer term moving average. This gives us a signal to buy the asset. So that could be the entry position. Then the next criteria, we should have an area where we should set the stop loss. As a general rule, with a moving average crossover, the stop loss should be a few pips below the longer moving average. And then we can set the target profit at roughly about 1.5 to 2 times the size or the area of the stop loss. That is just general guidelines, but you can set even higher target profits. So a trading system should have rules for entry. It should have rules for exit. Rules for entry is the rules that will tell you to buy or to sell. It will be the rules that tell you to buy or sell the asset. The rules for exit would be the rules to close the trade. So one of the rules for exit would be the stop loss. So the stop loss is where the asset price moves against you. It will close. Yes, it will be a loss, but the loss will not be as large as how it could have been if it had moved in a more unfavorable direction. So one of the rules for exit would be a stop loss. Another rule for exit would be the target profit. So you have an idea where you want your profit to be. So if the price of the asset reaches the target profit, the trade can close and it can give you your target profit. Your trading system should also have rules to buy. Your trading system should also have rules to sell. You should have an idea of where target profit should be. You should have an idea where your stop loss should be. You should also have rules for position sizing. Generally, if I have a small account, I would take trades with the smallest possible lot size. So I will take trades with a position size, a lot size of 0.01. That's the smallest possible lot size. However, as my account grows, I will take larger lot sizes. So if my account grows from $500 to, let's say, $1,000, I will take lot sizes up to 0.05. That's 5 times larger than the smallest possible lot size. And then I would add an additional 0.05 for every $500 increase in my account. So in other words, if my account grows from $500 to, let's say, $1,500, I will take lot sizes of 0.10. That's 10 times the size of the smallest possible lot size. That's just my rules. I trade conservative. I manage my risk. Some people are more willing to take risks. If you are a person that are willing to take risks, you can do so. Just be aware that if the price of the asset moves in an unfavorable direction, you can take a loss, and the loss can be large. The loss can be larger than if you had taken a very small position size. So understand, when trading, the larger your position size is going to be, the more risk you are taking, so that if the trade moves against you, the loss that you could take will be larger than if you are taking a smaller position size. So the next strategy I want to emphasize is a reversal strategy. My reversal strategy relies on a thing called Bollinger Bands. We call Bollinger Bands. So let me show you my strategy. I will share my screen. So I have a strategy to trade, and I have a strategy to trade based on reversals. So let me take off all the other indicators. Let me just leave the Bollinger Bands. So this is the asset here. This asset is AUDJPY. So I have some rules. First, with a Bollinger Band, the Bollinger Band is a confidence interval. It shows a range with 95% of the price of the asset will fluctuate or stay within. So when the price of the asset goes outside of the Bollinger Band, this gives us the 5% instance when the price will not be in the band. So look at what happened here. The price of the asset went outside the Bollinger Band. But since this is a confidence interval, this tells me that a reversal will occur, meaning that this is an extreme. This is an extreme. The price goes out of the band, or however, the price will go back in the band. So if the price goes out the band here, one of the things you can do, you can buy right at this point here, because the price almost definitely will go back in the band. So the price goes out here, it went back in. The price goes out here, it went back in. The price goes out here, it went back in. Goes out slightly, it went back in. So we can see here, the price went out here, it went back in, and went out. So generally speaking, the Bollinger Band is a good strategy. It will give us a lot of wins. Now, there's instances sometimes the price goes out the Bollinger Band, but we still don't get the best price to buy. Take, for instance, the price went out the Bollinger Band here, it went back in, but there was not a movement all the way back up. The price when it went down here, it didn't go all the way back up. The price went down here, and only when it reached here, it went back up slightly, and it still keep going down further. The ideal point to buy in terms of the Bollinger Band strategy was at this point here or at this point here, but the signal was sent at this point. So how do we counter this? How can we use Bollinger Bands to give us a very good point to buy? I use Bollinger Bands in conjunction with moving averages. I will take a short-term moving average. I will take a short-term moving average, and I'll have different criteria. So my first criteria to buy is that the price of the asset must go outside the Bollinger Band. So the price of the asset went below the Bollinger Band. The second criteria to buy is that the price of the asset must go back inside the Bollinger Band. So the price of the asset went out the Bollinger Band and went back in. The third criteria, to buy at the point of the price crossover. So here a price crossover occurred. So the price of the asset went down, went out of the Bollinger Band, and then went back inside. Here a price crossover occurred. So at this point here, this would be point to buy. This would be the entry position. Let's look at this area here when there was a rapid decline in the price of the asset. So we can see here, the price of the asset went down. Price of the asset went down. Now this could have been interpreted as an area where we could have buy the asset, but the real point to buy was this point here. So we allow the price of asset decline, go down, we buy here. So this is why I like the strategy. Yes, it's a possibility we could get a false signal like right here, but if we enter a position to buy, the stop loss will be somewhere right around here, so there'll be a small stop loss. If we allow the price of asset decline even further, we take the buy signal right here, buy. Now this strategy works on any asset. It works on oil, it works on gold, it works on silver, it works on Forex, it works on stock, it works on every single asset. Let's look at another asset. Let's look at this asset. This is another random asset. This asset is the CHF NZD, so that's the Swiss franc New Zealand dollar. So the price of the asset went out, it went out the Bollinger Band. So this is the first signal. The second signal, it went back inside the Bollinger Band. The third signal is the moving average, is the price crossover. The third signal is the price crossover right here. This would tell us to buy, to go long on the asset. And next criteria, signal number 1, the asset went outside the Bollinger Band. Signal number 2, the asset went inside the Bollinger Band. Signal number 3, buy at the crossover. We set the stop loss somewhere about here, and we wait. Could I buy somewhere around here? If we had done that, this trade would have been a win. This would have be an easy win. So our next criteria here, the asset went outside the Bollinger Band, went out again. Criteria number 2, it went back inside the Bollinger Band. Criteria number 3, there's a price crossover. So the stop loss somewhere around here, just below the Bollinger Band, and you ride it all the way up. Easy win. This is another area here. The price of the asset went outside the Bollinger Band. Criteria number 2, the price of the asset went inside the Bollinger Band. Criteria number 3, a crossover, a price crossover occurred at this point right here. So this gives us a buy signal. We put the stop loss somewhere around here and ride it. Now this trade would have broken even because what happened when the trade go up, I would have moved the stop loss from this point here to about this point here and just wait and see. Now, if you didn't do that and just leave the trade and leave it open, this would have just keep going sideways for a while and then it would have closed in a loss. So if this was a loss, this would have been a small loss. Look at another criteria right here. The asset went outside the Bollinger Band. Criteria number 2, the asset going inside the Bollinger Band. Criteria number 3, there's a price crossover. So we take a buy signal right here. And this would be a very easy win. So all the target profit was here, we can ride this trade all the way up. So assuming that we allow every time it go in profit, we move the stop loss from the loss position, I move it to break even position, and I'm shifting the target profit. If we had opened the target profit up, if we had increased the target profit and allowed the target profit to grow, watch by how much it would have grown to. So assuming that we ride this all the way up, we can take a trade right here and ride it all the way up here. So this is one of the reasons why I like these strategies, in the sense that when you take a win, it can be a big win. So the size of the win is very large. However, when you take a loss, assuming this was not break even, let's assume that this trade was a loss. The loss was small, the loss was just amount of pips. So if we take a loss, it will be a small loss. If we take a win, it will be a big win. This was a very good trade here. Small loss. If we didn't break even, and if this ended up being a loss, this would have been a small loss. This was a win. This was a big win. This was a win. This was a all right size win. This was okay. So that's my reversal strategy. My reversal strategy relies on Bollinger Bands. So criteria 1, the price must go outside the Bollinger Bands. Criteria 2, the price must come back within the Bollinger Bands. Criteria number 3, there must be a price crossover at the 8-point moving average. My third strategy is the duck trading strategy. 3 ducks. So I look at 3 time frames. I look at the 1-day time frame, I look at the 4 hours time frame, and I look at the 1 hour time frame. The moving average I look at is the 50-point moving average. So criteria number 1, the price is above the asset. Criteria number 1, the price is above the moving average. So this given buy signals from this point here, from June straight to February. So the point here between June and February, the objective now is to find areas to buy within this price range. So criteria number 2, the price should be upwards. The price of the asset should be above the moving average. Here it was barely above the moving average. This could from about here, so from the 10th of July, the criteria is being filled because the price was above the moving average. So these were some areas to buy. And this is the last criteria to buy right here. So we can see here, when you look at the one hour chart, there was price fluctuation. Now the price going up and touching the 100-point moving average. So the 100-point moving average was used as some form of dynamic support. Remember, we did resistance and support. The 100-point moving average was used as dynamic support. So we buy here at this point here. We buy here. So this is 3 duck strategy. We could have buy here. 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 We could have buy right at the point where the price of the asset goes below the moving average and then go back on top. So we buy at the crossover, or we buy where the price bounces off the moving average. We could have buy here. We could have buy here. Buy. First signal, we will not buy here. Buy here. It's a crossover, so we will not buy here. We buy here, buy here, we buy here. So the next thing we want to look at is the trading journal. The trading journal, this is where you monitor your trades. This is where you document how your trades has performed over a period of time. So you want to document or record how many wins have you taken over a period of time. So before you go live with real money, I recommend that you demo trade. You trade with a fake money, you trade with money that is not real, fake money, and you can record the performance of your trades. So you record how many wins you have taken, record how many losses have you taken. So the number of wins, the number of losses. What is the size of your average win? You need to take note of what is the size of your average loss. Why? Because generally speaking, we want the size of your win to be greater than the size of your average loss. Now, if on average, the size of your average win is less or smaller than the size of your average loss, that means something is wrong with your strategy is not working. Or if you take more losses, so if when you add up the number of losses and add up the number of wins, you take more losses than wins, then that suggests that something's going wrong. Maybe something wrong with your strategy, something is wrong with in terms of how you're trading. Maybe it is you're not managing your emotions. Maybe it is because you are setting stop losses that are too narrow, something may be wrong with your strategy, or something may be wrong in terms of how you're implementing your trades, or your emotions might be affecting you and affecting your decision making. You also want to take note of how many winning trades you take in a row and how many losing trades you take in a row. This is very important because sometimes you might take 3, 4, 5, you might even take 6 losing trades in a row. You want, if you take 6 losing trades in a row, that you can still effectively trade the market. If you lose 6 trades consecutively, it mustn't wipe out more than half your account to the point where you're now struggling to enter or implement any trade. You want to manage your risk. So if it is now you have a reputation or your track record shows that you can take a series of losses in a row, you don't want these losses to wipe out your account. Hence the reason why you need to manage your risk, and you can manage your risk with position sizing. So you also need to monitor what time of the day you take the most profitable trades. For me, the most profitable trades occur in the morning. So when I trade oil, when I trade silver, when I trade gold, I take the most profitable trades anytime between, let's say, 4 a.m. and 10 a.m. Generally, that is the case. You need to also monitor what days are your most profitable trades. For me, the days for my most profitable trades are Tuesday and Wednesday. Why? Because reports regarding the performance of the US inventories tend to be released on those days, and the price of oil tends to react to these inventory news. Now, when the price of oil reacts to these inventory news, if it is in the right direction, you can make an easy win. If it is in the wrong direction, you can make a loss, you can hit your stop loss. You also need to monitor when do you take losses. You also need to monitor how do you respond to news, meaning this, that when you see some report comes out, economics bulletin, some central bank report, a non-farm payroll report, how do you respond to news? Can you anticipate the news? Can you understand the news? Can you understand the news and execute a trade in the correct direction and profit from knowing the news? You need to know all these things and you need to document these things, because this can be an indicator to tell you if you are ready to trade the financial market. So a lot of traders enter the market and lose their money. 90% of traders lose their money. That is just a general fact. And that is the case for Forex, that's the case for bonds, that's the case for stock, that is the case for commodities. It doesn't matter which asset. 90% of the people that are engaging in retail trading are losing their money. And roughly 10% of the people that trade the market are winners. 10% of the people that trade the market don't lose their money, they win money. Why? Why the statistics for trading is so bad? Well, there are several reasons why traders lose their money. One of the reasons why traders lose their money is because of lack of knowledge. So I'll use an example here. When I was in my PhD program, so for one of my seminars in my PhD thesis, I was speaking about the financial market. More specifically, I was speaking about hedging on the financial market. Now, this examiner was telling me that he don't recommend hedging because he worked for a national oil company in Trinidad and Tobago. Well, for you, those of you in Trinidad, you could figure out what company was the national oil company. Anyway, that examiner said that he worked previously in a national oil company in Trinidad and Tobago, and they engaged in hedging of oil and they lose money. So he don't recommend hedging because of that. I replied that the reason why you all lose your money is because you all do not know what you were doing. Of course, when the examiner heard that, he was somewhat annoyed. He wanted to actually fail me for that defense seminar. So I actually had to do an extra chapter and go in detail and explain the fundamentals of the financial market. Now, that was in the year 2014. So because of what happened back then, I had to write a whole extra chapter about finance And that's what actually motivates me to get into the financial industry in terms of trading and so forth, because I actually realized that, hey, there are a lot of opportunities to make wins, easy wins on the market. But a lot of people don't understand the market. They don't know what is a chart. They don't know what's a candlestick. They don't know what is going long. They don't know what is going short. They don't know what's a trend. They don't know what is target profit. They don't know what is stop loss. They don't know how to manage the risk. They don't know what's position sizing. They don't know when bad news comes out, how to deal with the bad news. They don't know when they're in a winning trade, how to ride the winning trade and how to ride the momentum. And when the trade turns against them, how to adjust their stop loss as in a trailing stop. They don't know all these things. So when you go on the market and you're not properly educated, when you go on the market and you don't have the relevant information about the market, you can end up implementing trades and losing your trades. That was the reality. Anyhow, I ended up passing that seminar for those who wanted to know. So these are some of the reasons why traders lose on the market. They lack knowledge of the market. They don't understand the technical and fundamental analysis. They cannot read charts. They cannot read chart patterns. They cannot predict what the market will do. Not only that, they cannot perform fundamental analysis. They do not understand the economics. They don't understand the factors of demand and supply. So they want to trade assets, but they don't understand that the price of an asset is determined by the demand and the supply of the asset. So let's say you're looking at a currency pair, you're looking at the Euro USD. What affects the demand for the US dollar? What affects the demand for the Euro dollar? What affects the supply of the Euro dollar? What affects the supply of the US dollar? They don't understand these things. They go on the market and then they're going to lose their money. You have to understand economics. You have to understand the demand and supply. If you don't understand the demand and supply, you don't understand the fundamentals and news releases, and you can't even adjust your position to reflect the recent news, then it's a very good chance you can end up losing money. You need to understand the fundamentals of the market. If you're trading and you don't understand the fundamentals, you are guessing. If you are trading and you don't understand the technicals, you are guessing, you are gambling. I do not recommend that anyone engage in gambling. I recommend that you become educated, become informed about the market, know your assets in detail, understand technical analysis, understand fundamental analysis before you go on the market. So our next reason why traders lose their money is because they run down every price fluctuation. So yes, you want to make a profit, but that doesn't mean you have to run on every single change in price. You could take a few trades on a monthly basis. Sometimes for the month, I enter maybe about 3 or 4 trades, but the 3 or 4 trades I take are wins, and not just wins, are very big wins. So what you need to do is that you need to find the right entry price. Get the right price to enter a trade and ride the momentum, ride it all the way up. And every win you take will be a very big win. If you take a loss, the loss will be a small loss. So another reason why traders lose on the market is because they take too large position sizes. So when they take position sizes that are very large, they are taking risks. They are taking very big risks. But if you do not manage your risk, when the price of the asset moves in an unfavorable direction, you can end up realizing a very big loss. Hence the reason why I strongly recommend that you manage your risk, and you can manage your risk with position sizing. In other words, if you have a small account, use very small position sizes. And gradually, as your account increases, you can increase your position size. If you have a very small account, let's say you have an account of only $100 and taking position sizes of 0.10. All it takes is one bad trade to wipe out your account. It's as simple as that, because your account is too small and you're taking too much of a large position size relative to the size of your account. So you need to manage your risk, and you can manage your risk by taking appropriate position sizes. So I mentioned here managing your risk. Our next reason why traders lose their money is because they do not trade with a proven strategy. So a lot of people out there are trading and they might do a thing called copy trade. In other words, someone say that they enter a trade, they get the information about the trade that the other person enter, the trade that the person enter is in profit, and they decide to copy that trade. Okay, that might sound nice, but I don't recommend that. Why? Because that person might enter that trade and that person getting the trade on a very good price. You might enter that trade and you mightn't enter the trade at such a good price and you might end up taking a loss. So you need to do your analysis, and your analysis needs to tell you when is the correct time to take trades, when is the correct times to take a profit, when is the correct times to minimize your loss. You need to trade with a strategy that is proven to work. If you're trading with a strategy that is not proven to work, so you're trading with an untested strategy, then it's a very big risk you're taking, because you're trading with something and you don't know that it works. You need to test the strategy for yourself. In other words, you need to practice this strategy. You need to work on a demo account, practice this strategy, and your experience must tell you this works for you. Now, someone might have experience in implementing a strategy, but that person's experience is not necessarily your experience. You need to trade. You are trading for yourself. If you are trading for yourself, you need to implement your strategies for yourself, and you need to determine if your strategies are working for you. If they are not working for you, then do not go on a live account and trade with a strategy that has not been proven to be a winning strategy. A next reason why traders lose is because they are continuously changing their strategy. This is another problem. If you have a strategy, you need to stick with your strategy. You don't change your strategy every 2-3 days. That doesn't make sense. You need to have a strategy. You can start off with 2 or 3 strategies. You might have a strategy to ride the momentum, to ride the trend. You might have a strategy to trade against the trend. So the moving average crossover strategies and the 3 dot trading strategies are momentum strategies. These are strategies to ride with the trend. The Bollinger Band strategy is a reversal strategy. That is a strategy to trade against the trend, meaning that there was a trend going in a particular direction and there was some information released from the Bollinger Band signaling that the price of the asset might now move in the opposite direction. The Bollinger Band is a reversal strategy. My Bollinger Band strategy is a reversal strategy. Most Bollinger Band strategies that you use on the market will be reversal strategies. Moving average crossover strategies, price crossover strategies will be trend following strategies. You need to understand these things. If you're not using the appropriate strategy for the market condition, there's a possibility that the trade or the trades that you're taking may not be profitable. Another reason why people end up taking losses is because they never demo traded. You need to demo trade. You need to practice for yourself. You need to practice. You need to get your hand on the market, go on the account and practice. You need to see when the market opens. If it is, you can catch early wins in the morning and get off the market. So I try to get the wins between 4 o'clock in the morning and 10 a.m. But if it is you cannot wake up that early, you can set limit orders. But if you don't know how to set a limit order, then what you do in the market, you need to practice, you need to learn these things, you need to understand these things. Only when you're comfortable with these things, then you can go on the market. If you go on the market and you're not comfortable with these things, there's a very strong possibility you could lose your money. One of the common reasons why traders lose is because of this thing, emotions, trading psychology, emotions. They enter a trade, the trade goes in a loss, and they get anxious, they get frightened, and they end up closing the trade. However, if they had patience and had hold the trade a little while longer, that same trade could have turned around and could have gone into a profit. Or you can have an opposite scenario where they enter a trade, the trade's in profit, but because they do not want to take any loss, they close the trade very quickly and they close the trade and they don't capture as much profit as they should get. You want to hold your profits and you want to maximize your profits. With regards to loss, you want to minimize your losses. This is how you'll be profitable over time. This is how you'll be statistically profitable over time. You are not gambling. You want to take a statistical approach to trading. You want to systematically gain more wins over time, and you want your wins, the size of your wins, to be more than the size of your losses. And when you trade like this over a period of time, over the long run, you will be a winning trader because the size of your wins will outstrip the size of your losses. This will result in you having a very good reward to risk ratio. And one of the final reasons why traders take losses or they're not performing good in the long run is because they're trading too much assets that they don't understand in detail. You do not have to trade every single asset. Yes, there are 8 majors. Yes, there are minors. So when you go on any broker will be able to give you or allow you to trade about, let's say, 20 different currency pairs. They will offer you, they will also allow you to trade cryptocurrencies. They will also allow you to trade energy commodities. That's like oil, that's like WTI crude or Brent crude. Some brokers will also allow you to trade silver and gold. Some brokers will also allow you to trade indices. You do not have to trade every asset. You can start off by looking at 1 or 2 assets. As a matter of fact, I recommend that you pick 3 assets and do not trade more than 3 assets. So you pick 3 assets and understand those 3 assets in detail. Study the assets. You need to understand why the assets is going up, why the assets are going down. If you cannot explain why the asset is going up or why the asset is going down and cannot give an overall forecast about what is the expectation for the performance of the asset or the price of the asset within the next 2 to 3 days or within the next week, then you should not be on the market, because this suggests that you don't understand the fundamentals. You need to understand the asset, you need to understand the asset in detail, you need to understand what drives the price of the asset. If you don't understand what drives the price of the asset, you are gambling, and there's a very strong possibility that trading will not work for you. So this brings me to the end of this lecture. Well, it was a pleasure being with you over the past few lectures. This course is a practical introduction to day trading. There will be more content released in future courses. Thank you.